All right. Well, welcome everybody to another episode of the Volatility Barometer. I just had a massive fail about 10 seconds before I went live. My ring light sitting there just went from the setting that I usually have it at. It's at about 20, and it just shined at 100. I don't know what happened, so I hope that doesn't happen midstream. It's never happened before, so this could be interesting. I might get the spotlight at any point during this live stream. But anyway, try to regroup here mentally. That was kind of shocking, to be honest. But thank you for showing up, everybody. Today's going to be pretty casual, to be honest. We're just going to do a couple of segments here. One of them is going to be really quick. And then, of course, we'll do the live Q&A. So feel free to get your questions answered. Start putting them in the comments section there, and we will, of course, get to them. I am going to try, I know I say this every single week, but I really am going to try to keep it to about an hour, hopefully less than an hour. That would be awesome. I don't know, but I do like to answer every single question. So it just seems like every week we're doing an hour and a half, 2 hours. Not to scare you away, definitely ask your questions, but I am going to attempt for the first time ever to keep this pretty short. So Let's try. See some questions coming in already. A couple of good ones there. I will definitely get to those. So today we are basically going to talk about the VXX trade. And if you've been following the live streams for the last, say, done it. Sorry about that. Anyway, there was a comment there. It looked a little weird, but it's fine. As you've probably noticed, if you've been following our live streams, we've been working the short VXX puts and covered calls, and the strategy's gone brilliantly for about 8 weeks in a row. And then this week, of course, you've seen that the VXX has absolutely collapsed. Obviously very good for the broad portfolio, not so good for this specific trade. So I think a lot of you are probably quite curious to see where we stand at this point. How much of the profit we've actually given back? Is it all gone? Are we actually negative? And then I will show you how I typically deal with things like this, because of course it does happen. And then after that, we'll just touch really briefly on the VIX Contango streak, because people have been telling me they want to see the updated statistics. And then, of course, the Q&A, which I will try to get through everybody's question inside an hour. Challenge accepted. So the first thing that we are going to do is I do feel like I should just very quickly recap what the strategy actually is. So let's close that YouTube, and here we go. So I call it the Wheel of Fun strategy. This is something that I use an awful lot with VXX specifically, and it works very well with my portfolio, as I will explain as I go here. But the very basics of it is we basically start by selling a cash secured put on the VXX, and then two things can happen. It can either expire in the money and we get assigned those shares at the strike we sold, or it can expire out of the money. We keep the premium, we go back to step one, and we keep going. But we do actually want to get assigned those shares, because you can actually make a little bit more profit long term if you get assigned the shares, because then you can sell a covered call and you get profit on both sides of the trade, both the entry and the exit. And the covered calls, you can get really aggressive with them. And unless something crazy happens, like the VXX crashes down for 5 straight days, like it has this week, typically you are going to make pretty good premiums there. But I'll get into it in a second. But when you have the shares, you sell the covered call. Ideally, you're going to lose the covered call. You're right back in cash and you go back to step one. But it can, of course, happen where you don't lose your shares. It expires out of the money, and you just go back and you sell a covered call. So there's two wheels basically going here. But the ideal situation is very simply, and it doesn't have to happen in a perfect sequence. Sometimes you kind of linger on one of the steps, but basically you want to sell a put. You do want to get assigned the shares at some point because you're getting paid to do so. And then you sell the aggressive covered call. You want to lose the shares, and then you're back in cash. And you can keep going around and round. And depending on what the underlying security is doing, sometimes these sequences can last several months in a row. And so here's what we've been doing so far. So these are kind of everything that's happened in the live stream so far. You don't have to kind of go through this and catch up or anything. You can just jump in today if it's your first live stream. Of course, welcome. Come back next week. But this is what we've been doing, and it's been going very well. We sold the puts. We did get assigned at one point, lost our shares, got back into the puts, got assigned last Friday, and this is where we stand. So as of last Friday, when I sold the covered call, the VXX was around 2450, and I sold the 24.50 covered call. The total premium that we've brought in so far, $4.32, is obviously very good. This is a much higher return than you actually targeting for this type of strategy. I will get into it in a second, but if you want a ballpark figure for how I view this thing, is anywhere from about 12 to 18% for the whole year. And the reason I say for the whole year is because this strategy is what I personally call an overlay strategy. So this isn't something that I'm actually reserving this capital in my portfolio. This is actually, I'm using $25,000, which as of our live stream account, that is 20% of the live stream account, right? I have a long-term portfolio as well. I basically mirror the VTS portfolio over there, and I also allow myself 20%. Am I on screen share? Yes, I am. And so it's a 20% allocation. But I'm not actually using any capital at all doing this because I'm just using the available margin in the account. A lot of the things that I do, we're long the 2x equities, we're long the S&P 500, the NASDAQ, we're short vol with the SVXY. So I'm always going to have available margin for me. So this is what I call an overlay. And every time I say that, I do feel the need to just ethically speaking, try to warn people against using overlays because the typical overlay in the stock market, the financial industry that you'll see, these are people who, through slick marketing techniques, they actually get people to simply leverage up their portfolio, right? That's what ends up happening realistically. So they'll tell people that, hey, I've got this awesome strategy, and you might have a client there that's really interested in, oh, that looks great. I want to add that strategy to my portfolio, but I can't because I've got an entire portfolio of stocks, bonds, real estate, gold, whatever it is. So I don't have room, right? The slick talking marketing guy comes in and says, don't worry, we can just use the available margin in your account. You don't have to sell anything. And we can actually just add the overlay to your account, right? This is what they're going to tell you. And it's going to sound amazing, right? Who wouldn't want to do that? You get to add another strategy and it doesn't actually cost you any capital. It's just an overlay. The problem comes in, and hopefully you know this at this point if you've been watching my live streams, but the vast majority, and I would say nearly all, to be honest, of trading strategies are positively correlated to the stock market and therefore positively correlated to most people's portfolio. So when you add an overlay that has a positive correlation to the stock market, all you're doing is adding leverage, right? You're not overlaying anything that's going to add long-term performance. You are just leveraging up your positions because they're both positively correlated. So what ends up happening, and I've pointed this out many, many times before, and I say it over and over again, hopefully it's getting through people's head at this point, losses are always more costly than gains are beneficial. What ends up happening is in good times, that overlay will add performance and you'll think everything's fine. In bad times, it is just amplifying your losses. And so if you're adding performance in good times and you're increasing your drawdown in bad times, the simple math equation involved here, you are going to cost yourself long-term performance. That's what happens most of the time people use these overlays. They're almost always happy in the beginning when everything's cooperating, and then they nearly always regret it after when they turn around and think, oh, well, all I really did is add leverage, and now my drawdown's twice as big, and I didn't sign up for this, right? But by that point, it's too late. So adding an overlay with any positive correlation to the market at all is a non-starter. Don't even think about it. So if you're ever considering something like this, people will tell you, don't worry, we can just overlay the Iron Condors on top of your portfolio. Sure, there are some times that Iron Condors are neutral or negatively correlated to your portfolio. But there are also times, depending on the timing of when you open them, you could be positively correlated and you just added capital. So what happens when you do an overlay on a VXX put option? There is no risk to the upside at all. And it's not a timing thing. That's mathematically speaking. If you think about what's happening when you're selling a put option, you are selling something here, a put option, and if volatility spikes, if the market crashes, presumably that's not going to be very positive for your portfolio, right? Most people are net long the stock market. So you get a big market crash, a big volatility spike, a short put option, let me just get rid of that, can't lose money. All right, it spikes up, you keep your premium, you're out of the trade and you're in cash, nothing happens. If you're actually holding the shares and you have a covered call on, let's say you're on this step right here, Also, same thing. You just lose the shares you have, which is the goal anyway. You keep your premium and nothing happens. So mathematically speaking, there is zero risk to the upside volatility on this type of strategy. So I feel perfectly comfortable overlaying this strategy on top of the rest of my portfolio at a reasonable allocation. Now, obviously, you will want to be very careful not to drown out the rest of the portfolio, because actually I can just show you really quickly here. This is our, not that. This is our daily email from today. And you can see that our portfolio is 5 strategies with 20% each. You will not see the wheel of fun here. Remember, this is just an overlay that I do on top of my portfolio. People can sort of follow my live streams and they can do this if they like, but obviously be careful. But you can see that right now we are net long 2 times the NASDAQ. We are long the SVXY, which has obviously been great this week as the volatility crashes, and we're long the S&P 500. So 60% of our money is leveraged long the stock market. So I don't really care what happens to the 20%, as long as long term it's paying me. So I basically have the entire year to put out a 15% return with this amount of capital. That's the way that I look at it. You might think, oh, well, that's really not very much. A 15% return on an overlay, well, it's only 20% of the portfolio, right? So it's really only adding 3%. But first of all, it's not using any capital. So that's just a pure 3% being added to whatever you do. If you made 12% this year and your overlay made another 15 throughout the entire year, well, now you made 15%, right? And again, you think, well, big deal, 3%, why even bother? You want to see what 3% means? It actually surprises people when they see this. They don't really understand compounding, but start with $10,000. You make 12% per year, 25% capital gains. Let's just keep it there. Presumably you'd do this in some type of cash sheltered account most of the time, but short options probably not. But the rest of your portfolio would. I'll just keep it here just to be very conservative. Adding $1,000 a month, hopefully everybody's living below their means and saving money. I always preach that, minimalism, all that good stuff. And let's have basically zero real wage growth. I don't know what inflation will be or wage growth, but it's a pretty safe bet that it won't be very impressive going forward. So this person is going to, 30 years later, they're basically going to retire with $1.45 million. Okay? This person, 15%. Everything else exactly the same. They just used a little bit of an overlay that is mathematically negatively correlated to their portfolio, and now they're at 15 instead of 12. This person retires with 2.25 million. So you can see the difference here. It's essentially adding 50% capital, right? From 1.45, you're basically adding another 700,000 to your retirement fund off a 3% gain on the overlay. So don't overlook this, and you can actually get quite conservative. You don't have to go, like, it was going perfectly well for the first 8 weeks and we were just crushing it. But we don't need that. It doesn't matter. I've got the whole year to make 15%, so it's fine. But now you have to understand that sometimes you're going to get caught in one of these flush downs. And number one, if you're looking for sort of a quick little checklist on how to sort of save yourself when these happen, first of all, always be conservative. Second of all, don't ever overlay too much of your account. 20% is fine. I allow myself 40 because I've been doing this for over a decade. But 20% if you're new, maybe 10% if you're new. But the other thing is, of course, you need multiple strategies. As I showed, I am already net long SVXY, QLD, so I've made far more money this week than this strategy lost. But also remember from last week's live stream, hopefully you tuned in, I talked about how I actually trade a diversified portfolio of multiple volatility strategies. And the one we're talking about today is just one of the 5. But if you think about what happened this week, of course, tactical vol has done very well because VXX collapsed. Volatility trend was in cash because it's not ideal at this time. This one is losing money, and I'll get into how much in a second. VIX options had another easy month. It's uncorrelated, so it doesn't really matter. And volatility step, another winning month. So what you really want to do is you want to understand that there is no single strategy that will always perform well for you. You have to understand that stuff like this is going to happen to you. I actually initiated this trade right about here, and it was going completely perfectly all the way to here, and then worst case scenario for a short sort of VXX put generation is 5 straight days of absolute collapse. So what has happened essentially? Well, as of now, If you want to see the updated results, today I will sell a covered call, right? And let's just say for argument right now, I sell it for 40 cents, 10 shares. This is basically what I'm facing. But you have to remember, I hold the shares at $24.50. So I'm probably going to lose $3.50 if this 21 covered call, let's say it's 21. I haven't done it yet, but we'll get into that in a second. Basically, I would still be up money, right? I'm going to do 10 of those. I would actually still be up almost 5%, even if it exercises and I lose my shares at 21. So like I said, I've got the whole year to make 15%. This is not the end of the world. And obviously, I'm pretty happy that it did that, to be honest, because the rest of my portfolio did quite well. But this is the situation we're in. So what I want to do is I want to, first of all, initiate another trade, because I am sitting in this thing and I do hold the shares at $24.50. And if I sell a $24.50 covered call, I'm only going to get 8 cents. It's really almost not even worth selling, to be honest. So the real question is, how far down do I want to go? One thing that you can always do with this type of strategy is if you really don't like the landscape, you can just bail. So I want to show you what that looks like. People have asked before, like, what happens if you just want to get out of a trade? Well, what you would do is you'd sell your covered call really deep in the money. So let's say I chose the 20 and I would get $1.09 for that. So if I did get $1.09 there and I bailed out at 20, and that would mean minus 450, all right, I'm going to take a big hit when I get out of these shares, I would actually still come out of this with a profit. After 8 weeks, not bad at all, making 3.64%. That's in the positive direction. So you can bail out of these trades. But as I tried to tell people previously, because everybody gets really nervous when they're holding VXX, and you should. If you don't have a long-term plan, that is a terrible trade to be in. But if it is part of a premium generation and you're just holding that as the vehicle to generate money, then you can actually start to relax a little bit. And I've done this so many times, I'm actually quite comfortable holding the shares. So I can, I'm not thrilled right now, but I'm not going to just bail out of this and do a 20 or a 19 or anything. But I could do that and I'd still make money. But what I'm actually going to end up doing is probably this 21. So 51 cents, I'll just scope this out. That covered call would be for 51. And that would mean that if it actually is over 21 next week, what am I going to lose? 350, right? So I just like to look at sort of where I'm going to probably be. Come on, typing. This is kind of what I'm looking at. And we'll see what happens. Hopefully, in a perfect situation, it would expire at, 2075, 2080, something like that. I keep my shares and I do it again. And there you go. I'm still building my premiums. But what I'm going to end up doing is actually just go ahead, VXX, 10 contracts. I know that the market is still open, but obviously it's going to not get assigned here. So I'm going to go ahead and do 10 of these, and we're just going to keep this wheel trade going another week. Make sure it's the 21, 50 cents. Could I get another penny? Nothing wrong with trying to get one more penny, right? Every cent matters. 50 compared to 50.05. Toss is pretty good. The display is always quite accurate. Interactive Brokers, where my long-term portfolio is, it's absolutely terrible. It's a nightmare to trade there. I really only do it because traditionally the fees were lower, but these days it's really not even that much lower. I might just switch over, but there we go. I got 50 cents. So now I'm going to record that. So 10 times VXX covered call at 21. That's what I did, and I got 50 cents. So next week, if it does hit 21 and I did happen to lose my shares, this trade would be over. Come on, spreadsheet. I'm getting the beach ball here. Lose shares. So now we can just leave this. Everything's still fine. If it happens to go from, everything was looking incredible to now it's kind of just looking normal, so be it. So now the next question is I noticed that one person in the comment section asked about this. Do you ever average down, right? Obviously, this week has been a real gut kick for that specific trade, right? I do want to highlight that you'd never actually initiate a trade there. I should probably spell that out clearly. There's a very big difference between when you initiate your short put versus when you just sell another covered call. So you don't want to sell the put, the initial trade, when there is high potential for volatility crush, because that's when you get punished. If you were to have sold one there and start a new cycle, you probably would have lost your 10%. Remember, I use a 10% stop loss. I don't like to lose money during my overlay, so I cut it very quickly and just 10% and I'm out. So you wouldn't do that, but it was just a covered call. You always want to churn them right away. But what you do want to do if you're initiating a brand new position is you want to look for sort of bottoming out periods, more or less. There's nothing saying the VXX couldn't cascade down another 5 days or another 10 days. It could, but there is diminishing returns on the way down. And the lower it goes, the less likely it is to keep going lower. So the question becomes, when do you average down? And my rule in this strategy applies to all of my options trading. And you guys need to take this as just a general rule of thumb. Whenever you're doing, risk management, you're troubleshooting a trade that's gone badly, everybody thinks it's okay, I'll just average down. The one thing you need to ask yourself is, are you averaging down because that is a good trade to take? Or are you averaging down because the market is forcing your hand and you feel obligated to do it? So the test that I always apply to myself is, if I was in fresh cash across the board, I was not in the trade that's going badly, that doesn't exist, I'm literally in cash, would I initiate this new trade? If the answer is yes, then go ahead and average down because it's a good trade on its own. But most of the time in option trading, what people realize if they ask themselves that question, the answer is no. If I was in absolute cash across the board, I wouldn't take that trade. Picture an iron condor that's going badly and people tell you to close one side and roll out the other or do all these things. The typical answer, if you were really honest with yourself, would be, well, there aren't enough days to expiration left. The premiums are a little bit too low. I don't like how the market has moved and my trade is not centered around the right price. I'm only doing that iron condor adjustment because the market's forcing my hand. But if I was in cash, there's no way I would just initiate that single vertical spread on the side. So don't do it, right? Don't do something just because the market is forcing you to. I'm my own risk manager. I don't let the market tell me what to do. I decide what to do. So in this case, if you look at this trade, if I was in absolute cash across the board right now, would I initiate a new sequence of a short VXX put option today? Would you? Anybody who's watching this, would you initiate right now? The answer is yes, right? Obviously, yes. This is a very, very good time to be doing that. We've already seen the flush down. Again, not to say it couldn't flush again, but look, there is diminishing returns here. This is what we're looking for. And I have the added advantage that the bulk of my money is allocated to things that would offset this by a long shot, right? My beta factor, which I always show for the VTS community in every email, those three strategies are pretty net long the market. Volatility, trend, and condors are neutral right now, but we've got 60% of the portfolio doing pretty well on the long market side. So yes, the answer is absolutely yes. So what I could do and what I will do, and I always allow myself the potential for 2 overlays, but they have to be independent, right? That's the key, is that, why did I do that? I hit cut instead of copy like an idiot. Let me correct that. Oh, come on. Clicking around on live streams. All right, so I could allow myself to do this. And what would end up happening is I would just treat this new trade as a fresh new position, right? So I would just start again right now, and the September 8th, 2023, that cycle next Friday would be my first trade of the new one. And technically speaking, if I do get assigned, yes, it would be considered averaging down. But I always default to that rule. Is this a new trade, or is the market just making me do something I wouldn't normally do? In this case, this is a brand new trade. It's a very good setup right now. This is absolutely what I would do. I've already actually done it in my portfolio at IB, so I'm just going to kind of mirror what I've already done. And now, let's just forget this for now. Forget the whole thing ever happened. Let's just try to decide, if you started a new position right now, what would you do? So for me, I'm looking at this. What do we always do? We try to sell some type of reasonably aggressive short put to get the sequence going. So right now, the 21 looks fine. If you really wanted to be conservative for your first week in, you could do that, especially because it's an overlay. maybe just ethically speaking, I'm on a live stream, I'm talking about trading on margin. Maybe I shouldn't go so ultra aggressive. I guess there's nothing wrong with going ahead and selling the 2050. Probably I would do the 21. That's the one that I've already chosen in my other account. But let's go ahead and be conservative just so I don't give people the wrong idea. I am a conservative investor, and I've done this for well over a decade, so I know exactly what I'm doing. Trust me. I'm not afraid of tracking the VXX lower. And I'm going to do, again, 10 of these, right? 20 cents. Could I get 21? Let's see. Make sure it's the right expiration. The 8th. Good. Here we go. Let's try to get 21 cents. Give it, oh, it just clicked down. It's a live stream. I don't care about 1 penny. Let's go there and get this done. Click. There we go. I'll fill this in later, but I got 20 cents on 10 contracts, and I'm off to the races again with a fresh new one. Now, as of next week, I sold the 21. No, I sold the 2050. I went conservative. So if it actually goes below that, I will get assigned 1,000 shares. Remember, that is here. I sold a put. It can either give me the shares, and I would get 1,000 shares of VXX at 2050, or it can be above 2050, and I'll just keep my money and I'll do the exact same thing again. But when I get my shares, and I do kind of hope that I do, at that point I will have 2 allocations, and then the covered call I will just be starting to do 20 contracts. But I do want to reiterate, it is important to ask yourself that question. Are you averaging down like a dumbass, just throwing good money after a bad trade? Or is this actually a trade you would do if you weren't forced to do it today? Absolutely yes. That is a very good trade, the second overlay. So now the way that my brain kind of, adds all this up, I'm 2 times net long the NASDAQ, I'm long the SVXY, I'm long the S&P 500 in my main portfolio, and on margin, basically, I'm 2 times net short the VXX. And I've got a little bit of room there. I've got about 40 or 50 cents on average of wiggle room. Everything looks pretty good right now. So this has all been happening live for the last several weeks. If you want to go back and watch some of the other ones, probably a lot to learn here. This is something that I do a lot. I'm very comfortable doing it. But I guess I probably should have led the live stream with some type of disclaimer. These are not trade recommendations. I am just one of you. We're just a bunch of people hanging out together, and I happen to be taking some live trades. So obviously none of this is trade recommendations. What is that typical disclaimer? Consult a financial advisor. Don't do that. Financial advisor is terrible. I've actually got an idea for releasing an audiobook, and the title should probably be Fire Your Financial Advisor. It's, maybe I'll put that out next year, but that's pretty much it. So the other thing I want to do while I've got you here, some people asked, let me save this. Some people asked for an update on the really quite long M1, M2 VIX Futures Contango streak that we've got going here. I will just close that spreadsheet, open a new one. My spreadsheets, they take forever. But yes, it's been, I wouldn't say it's back to the glory days of the short vol trade, but it's actually been quite encouraging. So let's take a look at where we're at right now. We are actually facing currently the 3rd longest streak. So if anybody's wondering like, hey, what's he doing? I'm sure you know this already, but M1, M2 VIX Futures is just using the VIX Futures term structure. And if the second month is above the front month, and if both of those are above the VIX index, which is in green there, this is called positive roll yield, and this will be a headwind for the volatility ETPs like VXX, UVXY, UVIX, right? If this situation persists for a long period of time, those things are definitely going to be going down. And so that's what we're talking about here. So the inverse would be the same. If there's positive roll yield, the SVXY, which is an inverse product, it would be the one doing well. The SVIX, which is a 1 times inverse product, it would be doing well. So essentially, as volatility traders, we're looking for that situation to persist for an extended period of time. M2 higher than M1, both of them higher than the VIX index, right? That last part is actually quite important because the actual contango itself doesn't really matter. It can be in contango and the futures can still go up or down on their own. But if this positive roll yield persists for a while, you should expect some pretty good short vol returns. And we are currently on day 215. So pretty solid. third all time. And if you notice, second all time was not too long ago either. So you could make a case that while, again, it's not the glory days when shorting vol was everybody's thing until vol apocalypse, it's starting to look like a market where you can actually have some stability. Now, the problem might be, and I'll just give a general warning here, what ends up happening whenever you get this situation, of course, everybody and their dog is going to be making money shorting volatility now, right? It's easy. You just, no matter what you do, it's going to be working. Even the thing that I always warn against, which is taking undefined risk short vol trades, even that would be working right now. And you could really lull yourself to sleep thinking that, oh, this is so easy. I've got a great strategy. I've made profit for 6 months. Maybe I should start ramping things up. You have to remember, as a trader, very important to ask yourself these key questions, right? That one key question I said, would you do this with fresh capital? That's a great rule of thumb to carry with you. Another one is, am I making money because of something that I'm doing? Do I have an edge? Or am I making money just because it's a positive market environment? So if you look at the M1, M2 VIX futures, I'm not saying that your strategy isn't good. Maybe it is. But it is certainly possible to have a glaring mistake in your strategy and have it not have cost you yet. So now I know you've got some profit in your pocket for all you volatility traders. You've all made money the last 3 or 4 months. Now would be the time to start scrutinizing and stress testing and really trying to figure out, okay, the market's been easy, it's been cooperating, but what would happen if, fill it in XYZ market event? Stress test it now before it happens and really try to figure out whether you do have an edge or whether you're just the result of a positive market. It's not up for me to say, but typically people make this mistake after the crash. They lose all the money they made, typically more than they made. So they'll make money for 4 months doing something that's just working week in and week out. It's so easy. It's an ATM machine. On Twitter, money falls from the sky. And then all of a sudden you lose it all. And then people start to look back and do an autopsy on their strategy. What you would probably want to do is do that right now. Do that this weekend. It's a long weekend. Try to go through your numbers. Try to figure out where this is going to go wrong. Would you have done better if you did something else? You really got to figure out whether it's you or whether it's just this. Because, of course, you may not have been trading back then, but if you go back to 2018, 2020, a lot of people who thought they were pretty smart found out pretty quickly that they weren't. So just a fair warning ahead of time. Stress test now. Don't wait till the crisis and do it then. And of course, you can see that aside from a couple, which again, recent, you could make a case that, the short vol trade is coming back. Now, the volume hasn't. If you look at the volatility complex as a whole, it's nowhere near where it was at 2017, but it's actually pretty healthy right now. So good stuff. You can see here's the contango. It almost got there once. It was less than 1%. I think 0.17 or something very, very close. So we almost canceled the streak there. Last week, there was something a little bit, but it's been pretty solid and above long-term median. So all good on the short vol side of things. Just remember, I don't do these live streams to just talk to myself. I'm actually trying to educate people along the way. I've made my fair share of mistakes. I've got a lot of gray hair and I've earned all of them. I'm telling you these lessons that I have learned, sometimes the hard way. Sometimes I actually was smart enough to see it before it went off the rails. And this is one of those lessons. Try to make sure that you're not convincing yourself that what you're doing is just this incredible strategy. It very well could be. I do not want to belittle you, but it's been a pretty advantageous market period. So be careful. 215 days and counting of contango. Nobody's really expecting anything but short vol profits. So you don't want to be the one that gives it all back. And I don't want that for you. So, all right, can I get through these questions in 25 minutes? I do not think so. Okay. Do you ladder additional short VXX puts when the trade moves against you? So this was asked before I started the live stream. I showed you that I do. I'm very strict on that rule, but I actually am quite comfortable with 2 overlays at 40%. And again, just use that rule of thumb. Would you do it if you were in cash? Then go ahead and average down. If the answer is no, I wouldn't. It's not the right premium. It's not the right market. I'm only doing this because I really don't want to lose that money. Well, then what are you doing? Don't let the market push you around. All right. Does interest rate rising affect the stock replacement method with options? So he's referring, last week I put up a video about stock replacement. I'm going to talk about a lot more, to be honest. So you'll be hearing about this quite a bit in the future. Stock replacement's amazing. It's a way to simulate the underlying stock or ETF with options, essentially. And it's great because a lot of people can't trade the ETFs. You'd be surprised, even Americans, but certainly non-residents have an issue with this. And Europeans in the European economic area, that can be a problem. So stock replacement is a very good way for everybody to participate in short volatility trade, right? We can simulate the VXX without actually holding any of the ETFs. So does interest rates affect it? No, not really. I mean, no more so than the underlying that you're simulating, right? If you were simulating the TLT, for example, 20-year treasuries, you are subject to the movement of the TLT. So if interest rates rise, of course, the TLT is not going to do well and your trade wouldn't do well. But there's nothing like in the options specifically that interest rates would be overly affecting it. We are just matching up the delta and the contract size, and you're just simulating the underlying. Very easy to do. Okay. Do you consider SVXY, SVIX, VXX, VXZ, and ZIVB leveraged ETPs? Could you please elaborate on the reasoning behind your response? Well, I mean, I would use the word leveraged with SVXY, for example, but it's leveraged the other way, right? It's minus 0.5. So the reason that I guess I would say that it's leveraged is because it's really only the 1 times products that I would say unleveraged. So UVXY is leveraged the other way. It's 1.5 times. UVIX is 2 times. VXZ I would not call leveraged because it's not. It's a 1 times product. It's just using the midterm futures instead. Same with the ZIVB. It's not a leveraged product. It's a 1 times M4 to M7 volatility ETP. The only one on that list that I would call leveraged is SVXY. And I always say the 0.5 times leveraged. I guess exposure, it's a semantics game, really. You could call it whatever you want, but it's not the baseline, right? The baseline is the SPVX STR index or the short vol index, long vol index. Those are kind of the baselines. Everything else is a derivative of that. So yeah, I would call on that list just one of them. But if you don't like the word leverage, because they're technically not, SVXY is not like beta factor to the S&P, it's actually minimized. So I don't know if I answered your question, probably just semantics. Do you work Wheel of Fun together with the VTS portfolio? If so, what percentage of total account? Maybe I don't understand well the overlay. So no, I would never confuse my VTS community with the overlay. So in the past, I used to send sort of private emails and it went out to the annual subscribers. But the problem there was I actually did have several people. They loved it so much, and not to say I explained it too well, but when I speak honestly about why it works so well and everything kind of fits in, you can start to imagine people get really excited about it. Like you can, wait, you're telling me I can make more money and I don't actually have to allocate any capital to it? I can just work the inverse relationship and everything's great? And so we did have a few people who went 4 levels, 5 levels. They thought I was crazy to tell them to only do 2. And I was very, very specific and strict and conservative, and it still didn't work out. So kind of one of those things where a few people ruined it for the whole community. But it's just in good conscience, I had to stop sending those emails to people because every, 1 out of 50 people would just get overly excited. And then there's obviously going to be times when you just get it wrong. Like I said, there is no strategy that can navigate this with no risk and all profit. It just doesn't exist. My tactical volatility trend following loves these downdrafts, loves this. This is fine. We were in it as well. But of course, if volatility spikes, you better get out to the sidelines in a hurry, right? That's what we try to do with that strategy. Every time volatility gets elevated, we're going to skip out and go to gold and even long volatility. I'm not going to allow myself to ride this off a cliff, but there's a little band there where things can be going down or up in this case for the VXX, but down in the case of the SVXY. And you kind of just have to eat those losses. And whereas the wheel of fun strategy absolutely loves these periods, like from here to here is just nothing but perfection, right? Same with up here. This is fine, but it really doesn't like those major downdrafts. My volatility trend likes different markets. So the point is, you're never really going to nail it perfectly. And so what I like to do is I like to have a broad portfolio that's very easy for people to follow, very easy for me to follow, right? This is my portfolio. It's my money in all of this. And outside of that, there are very few things that you can overlay. And I mean very few. There's a lot of people on Twitter who will try to market stuff to you. Doesn't work because the mathematical correlations are not negative. Sometimes they might be lower, sometimes they might be higher, but they're not negative. There's very few things you can actually overlay. This is one of them. So, but I don't do it with the VTS community anymore. When we relaunch VTS options, this will be one of several strategies, and I'll go into it in great detail. And yeah, everybody will learn it. And for me personally, it adds some pretty decent alpha to my portfolio. But it is outside. It is extra. It's a live stream only type of thing. People just, doesn't matter how many times you tell them to be responsible. It doesn't matter how many times you tell them, look, don't sort of, it's not a good idea to deviate further than what I do. These are my strategies, right? Why would somebody assume that, I mean, I do a pretty good job. There's courses, there's emails, like blog articles, but you don't know exactly what the strategy is. If you did, you'd be, out there selling the VTS as well. This is mine. This is mine. Why would anybody assume that they can take my work, that they're only ever going to know 50% of the details, and then suddenly change the parameters and it's going to work out okay? It's not. I'm really the only one that knows the actual correlations and the math and why it all fits together. You will know a lot if you follow VTS, a million times more than if you had a financial advisor, that's for sure. You are contact with me every single day in the community, and all questions get answered, as you've seen. So, comparing that, you will be well informed, but you're never going to know to the point where, oh, I think he's wrong here, I'm going to adjust that, or I'm going to take the allocation different. Why would anybody do that? But they do. So, like I said, in good conscience, I do have to actually monitor the work that I put out there. I can't just blurt out everything, even though I want to, even though I want to tell people, if you just did this like I do, you'd sure like the results. People, for some reason, they just like to fiddle with it, change it. I don't know why they do that, but they do. So, sorry. I remember back in school when one person, they're chewing gum, they stick it under their desk, the teacher catches them, and now nobody in the classroom can chew gum. Well, that's kind of what it was. I was sending out overlay trades to people. One or two people got themselves into trouble, and it ruined it for everybody. So, all right. For long VXX puts, SVXY replacement, so this is the stock replacement, you mentioned 120 days to expiration for low theta considerations. Why not pick a longer duration, 200 days, with similar low theta? So really, this is just a function of the longer you can go, the better, because it does reduce that theta decay to almost nothing, right? You're referencing the graphic. Let's see if I can do it with my hands. Theta decay kind of exponentially increases as you approach expiration. So inside 7 days, it's quite vertical. 30 days, it starts to flatten out. 60 days. At 120 days, and my rule is 100 to 130, there's typically, not always, but typically some expiration available to trade. Over 100. Last time it actually didn't work out. We used 175, I think. It was the only one available. But that's probably just a residual of the VXX kind of doing its soft relaunch, so to speak. Remember, it kind of decoupled from the indicative value for a while. I think that's probably what's happening. Those further out, strikes didn't get filled in. But the further you go, you run into a liquidity problem. So it would be fine if you're doing it on your own. If you wanted to do 180 or 200, I think it would work fine on a small number of contracts. But the VTS community is pretty large. Lot of volume is going through those strikes, and so I have to be careful which ones I choose. And anything over, say, 60 or 70, the theta is not going to be overly punishing. Over 100 is fine. And at 200, liquidity matters. And personally, I never go that far out. This was asked before, of course, but You probably saw the answer now. Yes, absolutely. Right now is a great, oh wait, full disclaimer, this is not a trade recommendation. Don't do this unless you know what you're doing. Consult a financial professional. Yes, this is a perfect time to initiate a new Wheel of Fun put trade. I just like to talk. I wish you could just come on a live stream and just talk. I hate when you see on Twitter, people will say not financial advice, and then they go ahead and give financial advice. Like, just saying the words doesn't, dissolve the responsibility there. You can't just say, here's what I think you should do. By the way, not financial advice. It is, right? Every time we open our mouth, it is. It can be construed as that. So been thinking of doing this a while since you first mentioned it. First took the trade just now along with you. Not trade advice, but yeah, that second trade, the second layer, that I don't consider it averaging down. I just consider it just deploying my second wave. And the second wave is always more conservative for me. I would never do both at the same time, right? There's really no point to do that. You want to layer things, stagger it out over time. Like I said last week, I did a full presentation about what actual diversification means, across strategy, time, price, volatility, all these things. And so the second wave is there typically, not always, but typically when the first one's not going so well. And so that mathematically usually coincides with the second one being pretty ideal entry point. So if you did have the extreme patience and you were only ever going to allow yourself one overlay, not two like I do, if you're only going to do one, then you want to hold off a little bit on that first one. Every time you think, okay, today's the day, just wait till it bleeds down a little more. That, you might have better luck doing that. But I don't mind doing two because I know I've got the entire year. Sometimes you lose money. Like right now, I would still make 5%, so I'm totally comfortable doing this. But sometimes you actually do lose money, and so be it. Welcome to trading. It's totally fine. I've got the whole year to make my money. QQQ trade should be hitting 50% profit today. Do you mean the total trade that we've been in for all this time? I'm not ready to rebalance it yet. We've already made so much that we crossed the rebalance point. I very rarely rebalance my tactical strategies. Hopefully that's what your question's talking about. But we were in the QLD since the third week in March, and of course it's done extremely well. So the signal to get out of any of these positions and into a new one is the volatility metrics, not specifically the barometer, but something similar to this. But there are times when it made so much money that actually our allocation size decoupled a little bit, and the defensive was such a large chunk at that time. So we did have to rebalance. I'm not ready to rebalance again, if that's what you're asking there. It is, of course, doing well, has been doing well. Again, one of those things, is it me or is it a product of the market? Short term, it's always just the market. Long term, I'd like to think that it's all me because it's lasted, 15 years, not just 6 months. But yeah, going well. Not time to rebalance yet. U.S. Fed is targeting 2% inflation year over year. Insane. I don't even know why they say that out loud. But what about the 9% inflation, which already baked into the prices with no matching wage growth across the board? Yep. It's pretty crazy when the Fed talks about some target number and they just kind of forget everything, all those months, years, decades where they were off target and screwing everything up. And then if they do actually get back to 2%, I guarantee you the very next press conference, they're going to claim victory. They're going to say, look at that, we were right. 2%, we did it. What do you mean you did it? There was been inflation insane for months, years, and you're going to claim victory because you kind of hit it eventually? It just doesn't make sense. I don't know why the language, well, I do know why. They're not dummies. This is one of the things, I'll go off on another side tangent here talking about the Fed. But this is one of the things that really bugs me about, some people will call them stupid, of course. And it's natural to call the Fed members stupid, call the government stupid, the politicians, they're all idiots. They have no idea what they're doing. They don't know how to manage the economy. Have they not seen the national debt? Do they not know what inflation is? Haven't they seen rent prices? I mean, come on. What are they talking about, the CPI? It doesn't include food, energy. What else is there, right? We can all look at that and we can say, oh, they're just stupid. They just don't know what they're doing. Well, the truth is, They're actually extremely educated. They're very intelligent. They know exactly what they're doing. It's just that their incentives are not aligned with our incentives. That's the problem. So it gives the illusion that they're all morons and they don't know what they're doing. The Fed's just bumping around in the dark, just, pulling levers and not knowing what to do. It's not actually true. They're, a dozen very, very smart people sitting in a room, highly educated, some of the best economists in the world. It's just that they're trying to do something to the economy that doesn't align with what we want the economy to do. So I'm not saying you're not falling for that, but just in general, people out there, don't fall for that. Don't think that the people that are making terrible policy decisions on our behalf are stupid. They're not. What you need to figure out is, why are they doing what they're doing, right? Because they are smart. You cannot argue. I mean, some of them are Nobel laureates. So they have PhDs from all the best schools. They know what they're doing. Why are they doing it? That's really what you want to focus in on. It's too easy to just blanket statement say, oh, they're all dumb, Well, that's a conversation ender. There's nothing further than that. Oh, they're dumb? Okay, well then let's ignore them. They're not dumb. So we need to have our investments match our, thesis of the world around us. And I happen to think that the economy right now is A, terrible, much worse than it appears, but B, exactly where the powers that be want it, right? This is a long-standing engineering project to get it to where it is right now. And sounds crazy when people say that, call me tin hat, whatever guy, but it is actually good when the average citizen is struggling. It is good when you're in power and you're collecting taxes and you're, distributing things across society. It is pretty good if everybody is infighting, if everybody's angry and pissed off and on edge and, thinking everybody else around them is an idiot. This is very good for remaining in power, because if we did actually have the power to mobilize and vote incompetent people out of office or out of their positions of power, they wouldn't last very long. So you have to understand why this has all been engineered. And that is nothing to do with your comment, but just a total classic VTS live stream side rant. But these are not stupid people. The economy is awful. The debt is where it's at. The mismatch between wages and inflation and interest rates, by design, people. What are we going to do about it? That's all we have to figure out. What to replace QLD in Europe? I do not know. I don't like to say, of course, Europe's a big place. Every single country is different. But also, I'm a Canadian. I live in Dubai. I'm tax-free, and I have all non-US accounts. So basically, nothing that applies to the standard person applies to me. I don't have tax-sheltered accounts. I don't have American accounts. I don't have to deal with any of the tax situations. I am just the wrong person to ask. So I always just default and say, look, bite the bullet, hire a fee-based couple hours of somebody's time in your area and figure out the deal. SVXY, you might have a problem. You might simply just do the stock replacement. And there's now, I don't know how many are filled in with the course. I've been trying to go at a pretty good clip this time. I think there's 6 of them already. It's a 12-part course, and you'll learn everything about stock replacement in that course. It's for VTS members. So take the course and you can replicate. You could use, instead of the QLD, you could use QQQ options. Instead of SVXY, VXX long put options. Very easy to do. And no reason at all that Europeans can't find a broker in your area that would allow you to do options. Great thing about stock replacement is it's level 1 options. It's just long puts and calls. Couldn't be simpler. So a few moments ago, you briefly mentioned that you may sign up for some trading programs and review them. Yeah, a few months ago. Sorry, not a few minutes ago. Are you still considering that? I would. It takes some time because I'm not a very trusting person. I think that this social media experiment that we're running here is derailing a lot of people. And there's, hard to put a number on it, just number plucked out of thin air. But if 95% of the people that are selling services out there are actually just masquerading as experts when they're not, which is my personal opinion, then it's going to take some real deep dive. I don't just want to do a surface, oh, hey, that guy sounds cool on Twitter. 85% of the people that sound cool on Twitter can't outperform even a baseline benchmark, right? The smartest people on Twitter, a lot of them are just perpetual underperformers. So this is one of those things where if I was to dive in, I don't look at anybody else's work. I don't really follow too many other people. But if I was, I would want to do it justice and I would want to take it seriously. So haven't gotten around to it yet. But yeah, I'm not the only person who knows how to invest. I just don't have the time. Don't have the bandwidth to track what other people are doing. I like to do my own thing anyway. I've always just been self-taught everything across the board. It's quite misleading and scammy to keep saying that for the tactical volatility strategy, we've been in SVXY since March. That's simply an Excel backtest, and we, the clients, have only been in. Well, okay, so I understand the general tone there, but I do speak for several, thousands of hours a year. So what I talked about last week, there was actually an entire segment talking about that. Which spreadsheet do I have open? How quickly can I close this and open the other one? I talked about that for maybe 10 minutes last week, where the strategy signal itself was March 24th. We went long. Give this a second here. We're going to get a bunch of bubbles. We went long on August 1st, but that was not because any particular reason on August 1st. Somebody was asking, what was the signal? Like they're looking at the, where was the August 1st? SVXY. There's nothing standing out that you would go long on an August 1st, right? It just so happened that this is where we re-entered the strategy. So let's see if this is open and available. So the tactical volatility strategy has been in the portfolio at VTS since January 1st, 2012. And it was only removed for a year. And the reason it was removed was because we were seeing period where we were getting a lot of volatility spikes, but very few long-term trends. And so in that type of environment, you just get whipsawed around. So I made the decision after 11 years officially being in the portfolio to pull it out. There's nothing specific on August 1st that made me enter. It is just simply that is when we initiated the trade again. But the initial position is here, right? This is when the strategy would have entered. And this is all end of day. So there was one day where end of day it would have exited, but by the time I send my email, it was not. But yeah, you're right. We entered here. But that's it. I don't want to confuse people and make them think that something happened on August 1st that made me see the signals and enter. That was simply just me making a decision. I have to choose a day to reintroduce this strategy. And so what I did is I just picked a day. I just said, no matter what the market is doing on that specific day, we're jumping back in. And so that's what happened. We jumped back in on August 1st. But that's, kind of irrelevant to what I'm talking about overall. Like it's just the strategy itself is what I trade off of. And so, yeah, we had to exit it for a year. But I don't know. I'm sensing kind of a tone, and it's fine, but you have to understand that, and this is something you wouldn't know unless you actually talked a lot on camera, but I can't unpack every single statement for 20 minutes each live stream. Like sometimes you just have to say something and move on. I can't stop every 30 seconds and unpack this, but I already did it for 10 minutes last week. And then unpack, okay, what's a VXX put option? Sometimes I just have to say, sell a short VXX put. I don't have time to do a 10-minute video about what a VXX put option is. I just have to hope that you tuned in last week and you covered that, right? So no, I was certainly not implying anything. You know that our track record is absolute live trading results. The total portfolio solution, tactical volatility is not in there for the last year. So you're not, nothing has been, no wool has been pulled over your eyes. Our portfolio, I can even show it to you. I think it's live here. This will kind of illustrate it a little better for you. Closing so many of these windows. Here it is. Let's go screen share. So this is our results. tactical volatility was removed here and re-added here. So that little box, I hope you can see it, that little box does not include the strategy. I didn't backfill it. I should make a full video talking about this. But what most people would do, if they re-entered the strategy, what they would basically do is rerun the numbers on their portfolio and say, oh, here's what would have happened if we were holding it. You know, at VTS, I don't do that. There's no backfill. The tactical volatility is absent during that little box there. And I had to choose a day to get back into it. And in July, I just happened to choose August 1st. So that's what's happening there. But we covered that last week. I sensed a little bit of a tone there, so I have to go over it. Apologies if it was just like a totally benign question, but sometimes people have a little bit of loaded attitude, and certainly no reason for it. So a few weeks ago, you mentioned the momentum between different VIX metrics. What did you mean there? Well, that's kind of getting dangerously close to figuring out how I actually calculate stuff. So, you know, I almost never punt on questions, but that's kind of getting to the heart of some of my metrics. It's a pretty clever, well, calling myself clever. It's a method that I've not seen other people do to sort of build metrics that are more robust over time. And I'd just rather not share it, to be honest. Sometimes you have to just keep things that work well to yourself. Thoughts on SPY or Q's 60-day at-the-money calendar spread? Low VIX. Fine. Nothing wrong with that at all. If we were starting a new trade right now in the Iron Condor strategy, we have 2 open already. But yeah, if I was to initiate a new one, I'd probably go with calendar again. We're already in an Iron Condor, and it's actually interesting. This is just a total side tangent, but that Iron Condor actually crossed the stop gain. So when I sent my email, you can see it says 54 cents. My stop gain to get out with our profit is 55. It was 57 when I sent the email, but it's actually 54. So if things hold, on Monday we'll be getting out of this trade, and we'll just take our profit. Within a couple of days, it'll certainly go over. Well, I shouldn't say certainly, but very likely we're just going to duck out of this one. And that would mean that this trade is closed out. I'll get into a new calendar. And like you said, with low-ish volatility, not historically, but relative to the last 1 year, right now is more suitable to use calendars than Iron Condors. So yeah, absolutely nothing wrong. I would just look at, do I want SPY, Qs, or IWM? Basically those 3. Those are my equity underlines that I target. It's at 49% right now. Oh, yeah, okay, gotcha. You were referring to the Iron Condor. Yeah, my bad. I thought QLD for some reason. I went on that whole rant. You were talking about Qs. I just answered that, ironically, just as I saw this question. It's at 49. Mine ticked over. So if I was sending my daily email right now, I would send it out to take the profit. But I always just think once per day. There's no advantage to watching every tick of the market and I'm in now, oh, I'm out now, now I'm in. You know, it's just, it doesn't do any good. This is the whole day trading thing. I have, unless somebody actually shows me a track record, which miraculously I've never in my life seen one. Everybody just talks about how they make so much money trading. I've never in my life, literally not once, seen a day trader show that a track record that is legitimate. Don't know. But basically, I don't think trading more than once per day is beneficial. I think you just treat the market, short-term random noise, once per day, just look at it. Is it in? Is it not? If it isn't, you just, go on about your day. So it's just a 2-hour difference there. I would close it now, but that's not the deal. So Monday's a holiday. Tuesday, when I send the email out, don't be surprised at all if the Iron Condor gets closed. How far out would you go on a VIX Iron Condor? I personally don't trade Iron Condors on the VIX. I use straddles, diagonals, just differences. But you could. And how far would you go? Well, I do monthly cycles. The VTS options, when it starts going again, I will go through all the VIX option stuff and you'll understand why monthly cycles work best. But you could do like 1 to 3 months, sort of the same deal as equities. 1 month is fine, but you'd want to use stops. You'd want to buy some out-of-the-money calls. And then 2 months is sort of our standard 45 to 75 days. Nothing wrong with that either. Okay. If you cannot get an IB Pro, you can use Exante. Is that how you say that? They allow you to use US ETF. So I would imagine you're helping our friend answer what to do in Europe. If you have IB Lite, use options, Qs, with high delta and buy double the shares. Yeah, so if you're doing QQQ on trying to simulate the QLD, the highest delta you're going to get that's reasonable volume is probably like in the 0.7 range. So if you really did want to do QQ or the QLD, you might have to do 3 times the contracts at a 0.7 delta. But because options are so capital efficient, there would be no reason you couldn't do that unless you were literally in a cash account. And then some of this becomes a little problematic to simulate the leveraged products, because the leveraged ones, they typically don't have a robust options market. So, you might just have to trade the unleveraged. But if you are in a margin account, you can simulate anything, absolutely any exposure you want. But again, I don't get into this because it's way out of my wheelhouse. So I will just default to the professionals who know better than I do. I don't know what underlying ETFs are available for Europeans. I always just say, look into stock replacement. Not saying you have to do it, could do it, whatever, but there's a course there. It does work very well. All right, I think we got through all the questions. So what time is it? 1:06. That's amazing. That was actually the fastest we've done so far. So I will give everybody sort of like an extra 3 to 1 minute, maybe 1 minute. Anything last minute that stands out. It's amazing. People never really ask me any off-topic questions anymore. When I started my live streams way back when we did, this is episode 67 or something, it was about 50-50. People used to ask a lot of personal questions, about everything, about religion, about girlfriends, about, all kinds of stuff. And now none, absolutely none. It's very rare that somebody will ask me anything off topic. So don't forget that I am, if you just want to chat about stuff, learn about stuff, maybe it means that you're all regulars and you always watch them, and then you actually know everything about me at this point and you don't care. Could be that you just don't care from the beginning. This is interesting. I like this. When you get back to Dubai, okay, you got residency last week. Wow, congratulations. I would imagine that you're in the next 4 to 5 years, certainly 10 years, mark my words, people don't believe me now, and I've been saying this for a number of years now. People don't believe me, but the Middle East is going to be turning people away. That's how many people from the West are going to want to move to the Middle East in the next 5 to 10 years. Not just the UAE, but we're talking about Bahrain, we're talking about, Qatar, however you want to say it, Saudi Arabia. Give Saudi Arabia 10 or 15 years. It's not ready now, but 10 years, they'll have so many people wanting to move there, they'll have to turn people away. They'll have to adjust their residency programs. So I believe you did that at the right time. In a few years from now, I don't know if you've noticed, but it actually doubled. The amount of money that you need to get residency doubled. And I would imagine that every couple of years, it's going to be harder and harder for people to move to Dubai and Abu Dhabi. It's just, if you're not actually tied to a location for a hard reason, it just doesn't make a whole lot of sense to not at least consider elsewhere. So congratulations. And yeah, when I get back, I think this trip, it might be a while. I think it might not be till November or December, but email me for sure, or I should actually email you when I'm back. Yeah, we should hang out. I don't know if you're a golfer. If not, we'll just go grab a beer. Cool. Love Dubai. Hope you love it as much as me. It's just amazing. All right. Is it nice Taiwan for vacation? We answered this last week, actually. This comes up a fair bit. People say, I'm going to go to Japan or Thailand or Korea. The way that I always put it is, of all the Asian countries, Taiwan is probably number one for living. Like if you just wanted the best life, you're going to get really good weather, super friendly people, very forgiving if you don't speak Chinese. Very easy country to get around in, convenient. The food's awesome. There's tons to do. There's Western communities if you're into that. Otherwise, Taiwanese people love Westerners anyway, so you'll meet friends. It's a really, really good place to live. But to visit, if you were going somewhere for 2 or 3 weeks, this surprisingly might actually be lowest on the list. I would rather go to Japan for sure. That's my favorite. But China has so many incredible places. You wouldn't want to live in China, but visiting there, phenomenal. Korea, which I've never been to. My wife's been about 20 times probably. She loves Korea. Cambodia, Vietnam, Thailand, they're all more fun. So as far as a vacation, skip Taiwan. If you're looking to move somewhere, consider Dubai. But yeah, Taiwan's an amazing place as well. Oh, there's another investing question. So I broke my rule. I'm not staying just for an hour. What about short SQQQ and SL 30% and reshort it when it gets close? Well, same rule applies. Why would you short something? You're just Ecam not showing questions again. Nope, it's not. I don't short anything. No undefined risk. There's no point doing that. So if that's what you mean, actually shorting the inverse triple leveraged Qs, why? There's so many safer ways to go about doing it, and you'd make more money and you'd put on less risk and you'd have less capital. And I put up a post on Twitter. Somebody emailed me. I don't short anything, so I actually didn't even know this, but he emailed me the borrow fees for shorting UVXY. It's at 26%. So it's just a complete non-starter to even consider doing this. You're never in control of your own shares, so that's a huge problem. And they will get called away on you at the worst possible time. It's just kind of how it works. Nobody calls the shares away when everything's calm and going well. It's typically at the time that you would not choose. So no, I just don't do that. Yeah, Ecam not showing questions. Ecam never shows all the questions, so I'm not concerned about that. But you asked last week about me blocking and hiding stuff, which I answered I'd never do. I'm more concerned about YouTube blocking your questions. And you said again, so... Ooh. Is this the question? I just missed it. Yeah, there was there was a whole bunch of these in a row, and I just kind of skipped through there's one in the middle. I just skipped this. Is this what you mean? What factors could pique your interest in replacing SVXY with ZIVB? Right now, nothing, just the passage of time. Right? I tend to look at things not very short term, but sort of medium term. And it's been 5 straight years where SVXY has outperformed ZIV from a risk reward perspective. ZIV has done well recently, but when you factor in how big it spikes, what the profit is during the long-term trends, from 2012 to say 2018, January, right up to Volpocalypse, ZIV had the best risk reward ratio of all the volatility products. It would spike the least, of course, because it's a slower moving M4 to M7, but during longer term trends, it actually performed quite well. And it wasn't half of the XIV. It was actually a little bit better than half, but the spikes were way less than half. So risk reward, it was awesome. And that's why I used to say it's my favorite product, the old ZIV. But since Volpocalypse, it's just not the case anymore. So what would change? Well, I need to see a longer term track record where that's no longer the case. I won't know now just based on 3 months. It's been, like I showed, 215 days of absolute calm. Now is not the time to be making decisions on which ones are the best. They're all doing well for their own reasons. I need to see a little bit more evidence that the ZIV is truly back to its lower spikes, but still profitable during trends. Haven't seen it yet, so give it some time. I believe that's it. I mean, I could get myself in all kinds of trouble with my email inbox if I just flash it for you right here. But if you want to see the tactical volatility, this is just end of day sort of how the strategy is built in the spreadsheet. And then, of course, it's not this complex. It spits it out into a single trade signal, but it's a pretty massive spreadsheet. I think I passed it. But you can see here, you can see why I'm currently not using the ZIV. It's just not not a benefit right now. So right now we're targeting this green line. This is my ideal risk reward. People might look at the SVIX, the 1 times SVIX, and think, oh, you could make more money. Yes, you can, for sure. But I don't think people fully understand how uncomfortable a 50% drawdown actually is when you're in it. So I do think that this is just far superior for a risk-reward perspective. That's why we use this one. But you can see the ZIV is not better, right? The performance is a little worse, but the drawdowns were just too large. And if I were to show you what happened for, the first wave of this, risk-reward wise, the ZIV was as good or better. But this 0.5 SVXY is pretty solid right now. That's an excellent risk-reward ratio. It's the same reason why you don't make as big of a return with the SVXY, the 0.5. It's just, half as strong as the SVIX. But mathematically speaking, you are always better off reducing your drawdowns as opposed to getting the bigger gain. Always. And this isn't just me saying, we can manage the risk. This is mathematically speaking. Losses are always more punishing. Just across the board, it's a fact of math. So anytime you can do something to reduce those times where you get caught, because we all do, all traders get caught with something. We don't anticipate everything. The market does surprise us sometimes, and you will always have periods that just surprise you how bad you're doing. You're like, this hasn't happened to me in 10 years. Well, it's going to, right? So it happened to me in 2022. I started in 2005. I never had a drawdown over 12% portfolio wide until last year. And then it went to 25. Never happened before. I can't sit there and say, oh my God, this has just never happened to me before. I can't believe it. This will never happen again. Let's just keep doing what we're doing. Let's go for the big returns. I knew ahead of time that was going to happen eventually. So I wasn't leveraged up. I wasn't one of these guys talking about undefined risk. Like, let's just trade the 2 times across the board. Let's short vol with double leverage. I was never that guy because I always knew, even though it hadn't happened yet, I knew that day or that year would come when nothing works. Everything I do, I buy this, it goes down. I sell this, it goes up the next week. That day is coming for all of us. If you don't think it is, you haven't been trading long enough. It's coming. So the SVXY at its current 0.5, a lot of people scoff at it and they think it's not good enough. I need the SVIX. I need the UVXY. I need the UVIX, that new 2 times. Bring back the old TVIX. No, that is not how you trade successfully long term. Long term, I'll be the guy that's still left standing because I'm not going to suffer those gut-wrenching drawdowns that make you pull the plug at the worst possible time. So that's why the ZIV was so good. And the SVXY is right now so good. That's why, because it's watered down. And we can use it to make 30% a year and not really, it could still happen. Anything is on the table. But to suffer a catastrophic loss is unlikely, right? Especially if you're tactically rotating. But with the SVIX, it can go down 20 or 30 in a day. Get 2 or 3 bad days in a row and you're already in a drawdown that's going to make you want to quit. It's just too strong. So ZIV hasn't impressed me lately, but give it some time. Maybe it will. Maybe there will be a return to the ZIV. Who knows? I don't think the volume is going to be anywhere close to the old one, and the old one sucked anyway. So I think the ZIVB is just dead in the water. I appreciate the team that put it together to try to revive something that I used to like so much, but it's just not going to make it. It just isn't. The cost of managing an ETF that has that low volume, it's got to ramp up more or it's just not going to be worth the hassle. So I appreciate it that it's there. And I'm the number 1 cheerleader for it. And even I don't think we'll really use it. Okay, as non-US, I should just go to bed, shouldn't I? It's 2:30 in the morning for me. As non-U.S. resident, when you have SHV, you pay taxes on dividend 30%, or will you sell 1 month? Well, there's withholdings, and then you have to sign all the papers, and you have to show tax, and you get your money back. They don't just keep your money unless you don't sign those papers, right? Always keep your broker account up to date. Always make sure that you have the tax relationship with your country, so you're only taxed once. You have to be up to date on that because they can, of course, just there's that one, the W8BEN, the W8BEN, whatever. You got to sign that every year. You got to make sure that you have a tax number, and you will. They're not just going to take your money, but sometimes there's typically going to be a withholding there. Like I said, don't track anything that I personally do. I'm a, Canadian non-resident for 25 years that has U.S. accounts, that lives in Dubai, that, come on. Nothing that I do applies to anybody else. But yeah, you said, thanks for showing you the chart. The reason I hesitated is because it is going to be a lesson in the course, of course. I'm going to go through why we wouldn't choose the other two, and there's going to be entire videos. So sometimes on a live stream, I'll flash something like this, and then people will, it's a long weekend. I would imagine somebody's going to email me about that chart that I just sent. So what I would like to do is just have an entire course and just give this strategy away in part of the VTS options course. Just explain it A to Z and send people the actual spreadsheet is the ultimate goal. But that can't happen until I fill it in with about 30 videos and get VTS up and running. So there you go. Little teaser for the future. You will at some point be taught absolutely everything, and you will just be given the strategy. So that is on the horizon. All right, I should, not that I'm tired, I go to bed at 3 or 4 a.m. anyway, but the markets here close, because I'm in Taiwan now, I'm not in Dubai. And Dubai, the markets close at midnight, so it's pretty much perfect. Here, they close at 4 a.m., so I'm typically up very late. And wife and I are just, we're always conscious of our weight. We're trying to work out, always trying to lose weight, stay in shape. And we do end up drinking wine and eating cookies, and yeah, it's kind of a disaster from about 1 a.m. to 4 a.m. So the only time I can really avoid that is to be on the live stream, so I can't be sitting here eating and drinking. Otherwise, Taiwan, as a trader who has to stay up till 4 in the morning every day, it's trouble for the late night snacking, to be honest. So I do like Dubai better. I'm thinner in Dubai. Not that it matters. It's not like I'm in a movie or anything. All right, here we go. Why do you think VXX is better than UVXY in terms of long put? I don't. I wouldn't say better or worse. 5 years ago, I would have said UVXY doesn't have the option volume, but these days it's plenty. So there's absolutely no reason why you can't use UVXY to sub in for everything. This kind of gets back to the point of the person who asked earlier. The thing that I broke down in quite a bit of detail last week about how we didn't enter until August, but the strategy said we entered in March 24th. I already talked about that so long last week, I didn't mention it today. This is another one of those things where, every time I speak, every time I say VXX, I suppose I could say, oh, and by the way, you can also use the UVXY. You can also, sub this and that. And then when I talk about an iron condor on the SPY, I could also say, yeah, you could do IWM as well. Yes, you could do the Qs as well. It's just for pure brevity, there are things that I have to gloss over or I would never get through a live stream. So absolutely from this day forward, every time I say options trading on VXX, you can just sub it interchangeably with UVXY. The volume is good enough on both of them. And in fact, now that I'm on the subject of just unpacking everything, our volatility trend strategy, we very often use the UVXY and actually more often than the VXX. This is broken wing butterflies, by the way. So it's like we trade basically broken wing butterflies that are somewhat like the Wheel of Fun that I went over, where it's negatively correlated to the market and the portfolio. So we can just kind of, we can basically open these at will because the rest of the portfolio is going to cover any losses here. But it just has not been advantageous. The premiums lately have been terrible, so we've just been in cash. But yes, UVXY and VXX are both totally applicable. I can't say it every single week, so that's why this cycle for the VXX we're doing, or this Wheel of Fun, the ones that I showed you, maybe next time I'll just do UVXY just to make that point clear. They are the same. All right. That's it. Let's end on a compliment, boost my ego a little bit there. So thanks everybody for tuning in. I ran 24 minutes over. Hour 24 is almost a record for me for short. I can go for 3 hours, as you know. So careful asking questions, because yeah, we'll be here a while. I would, as I always say, I would rather do more streams shorter, but I just feel awful ducking out. I'm staring right now, like when you're watching the stream, you see me looking kind of over here. I'm basically just watching the feed, and I always feel terrible when I leave the stream and there's still questions. I like to be, I don't know about the only, but certainly one of very, very few people in the investment world who will just sit up in front of a live audience. I don't know what questions are coming. It's blasted out to the public. I don't know who's a paying member. I don't know who's not. I don't know if somebody's going to try to, have a gotcha moment. I have no idea what's going to happen. I'll just sit here in front of a live stream for 2 hours every week and just answer everything you've got. So there's not many people that can do that. I'm not aware of anybody else who does, but actually I should make it a point. If you are, let me know. I'd love to see it. I'd love to watch somebody else who's doing this as well, see how they do it. Maybe I'll pick up some tips on, should I have one of those boards that has the horns like Kramer on TV, like, buy, all that stuff. There's, what is it called? The Elgato Stream Deck, I think. Some of you who do YouTube will know what that is, but you can just preset it with a bunch of buttons and sound effects and different, graphics going across the screen. Yeah, I'm almost 50 years old. I think I'm a little bit past that, but hey, maybe I'll pick up some tips. So if you see anybody in the volatility space, for sure, but even just investing in general, and they do what I do, they kind of just sit here and you get what you get and the questions are there and nothing is prepared ahead of time, I would love to get a link for that. I'd love to learn. I'm always trying to get better, and I think there's a lot of room for improvement for my live streams. All right, cool. So we're in a little bit. Let's recap the VXX really quick. That doesn't look right. That's not a real trade. Trust me, I'm not trading a strangle. What are we in? We are in level 2, getting a little bit uncomfortable maybe for some of you, but I've been here before. I know exactly what's going on. I'm still up 5%. I was up 17 and now it's down to 5. Wouldn't you know it? But layer 2 should be good. So this is going to be fun. We'll see how long this goes. I've been in these trades sometimes. The only thing that really kicks you out of these Wheel of Fun trades is if the price goes really far away from where you're at. So for example, right now, like I initiated here and it was at 24.80, I believe. And right now we're sort of still in the ballpark. So this is all the same trade, just week in and week out. The only thing that would kick you out is if you basically just have to reset at a higher level. Take a couple weeks off. You never initiate a new trade after a vol spike, because the risk to the vol crush on the other side, it can stop you out in days. You can get stopped out in 3 days if you do that. So when it spikes, of course, there's zero risk. You just kind of take your money and get it off the table. And then you sometimes do just have to wait a couple of weeks and watch it cascade down. And at that point, you're hoping that you've filled it in with some other strategies that are going to do quite well when it's cascading down. And then when it's at a point where you feel pretty solid that it might start bottoming out, then you can actually start hitting these really hard and go for the old Wheel of Fun as aggressively as you want, as long as you've waited for that vol crush. So, no, don't open that. All right, I should go. Seriously, I should go. Turn the camera off, right? All right, thanks everybody. See you next week.